Hello students, after studying this module, you will be able to know the role of finance function in strategic decision making and also understand the important components of the financial strategy. Selecting the optimum investment and financial opportunities using the financial models that maximize the expected returns in absolute terms at minimum risk. What concerns the investor is not simply the maximum profit, but also the likelihood of it arising from risk return trade-off from a portfolio of investments with which they feel comfortable and which may be unique for each individual. We call this as an overall approach to strategic financial management and define it as being the application of strategic decisions of financial techniques in order to achieve the decision makers' objectives. Although linked with accounting, the focus of strategic financial management is slightly different. Strategic financial management basically combines the backward looking, report focused discipline of financial accounting with a more dynamic, forward looking subject of financial management. It's basically about identification of possible strategies capable of maximizing an organization's market value. It involves the allocation of scarce capital resources amongst competing opportunities. It also encompasses the implementation and monitoring of a chosen strategy in order to achieve an agreed objective. Let us now discuss various functions of the financial strategies. Financial strategies are a portfolio constituents of the corporate strategic plan that embrace the optimum investment and strategic financial decisions which are required to attain the overall specified objectives of a firm. In this connection, it is necessary to distinguish between the strategic, tactical and operational financial planning. While strategy is a long-term course of actions, tactics are the immediate plans to achieve these long-term objectives. While operations are short-term functions, operations are even shorter than tactics to achieve the overall strategy. Senior management decides the strategy, the middle management typically decides the tactics, and the operational levels basically look after the line management. Irrespective of the time horizon, the investment and financial decisions basically involve the continuous search for the best investment opportunities. A firm has to be vigilant for that. Selection of the best profitable option, determination of optimal mix of funds for the options, establishment of systems of internal control, and analysis of results for future decision making. Since capital is a limiting factor, the strategic problem is that financial management is now limited to allocating funds for alternate uses. This dilemma of corporate management is resolved by the pioneering work of Jensen and Mackling, which is popularly known as the agency theory. According to this theory, the financial management strategy is a function of four major components based on the mathematical concept of net present value, which you all know. Net present value maximization. These four main components are: firstly, the financing decisions; secondly, the investment decisions; thirdly, the dividend decisions; and fourthly, the portfolio decisions. The key decisions falling within the scope of financial strategy would include the financing decisions with regards to the mode of financing or a mix of equity and debt capital. Investment decisions, the decisions which involve profitable utilization of the firm's scarce resource, that is the funds, especially for the long-term projects. Since the future benefit is associated with these projects, which may not be discernible in short run, right? So there is a risk, there is an uncertainty, and investment decisions need to be made on the basis of these two. The projects are evaluated in relation to their expected return for the amount of risk that we are going to bear for them. The third set of decisions, the dividend decisions, is basically to determine the division of earnings between payments to shareholders and reinvestment back into the company. The third set of decisions is the portfolio decisions. The decisions which involve evaluation of investments based on their contribution to aggregate performance and entire corporation rather than on isolated characteristics of investments themselves. Financial planning. Students, as we all know, financial planning is the backbone of business planning and corporate planning. It helps in defining the feasible area of overall operations of all types of activities and thereby defines the overall planning framework. Financial planning is basically a systematic approach whereby the financial planner helps the customer to maximize his financial resources by utilizing the financial tools in order to achieve the financial goals. There are basically three major components of financial planning: the financial resources, that is FR, the financial tools, the FT, and the financial goals, the FG. And financial planning encompasses all three of them, that is FP is equal to FR plus FT plus FG. For an individual, financial planning is the process of meeting one's life goals. We all have life goals, and for this we need to have a proper management of the finances. These goals will include buying of a house, saving for children education, planning for retirement, etc., etc. And in this process, we have to have specific steps which help us in taking a big picture look of where you are in terms of the finance. Using various steps, you can work out where you are now and what you may need in future and what you must do so that you can achieve those goals. Outcomes of financial planning are basically the financial objectives, the financial decision making, and the financial measures for evaluation of corporate performance. Financial objectives are basically decided at the very outset so that the rest of the decisions can be taken accordingly. The objectives need to be consistent with the corporate mission and the corporate objectives. The financial decision making basically helps in analyzing the financial performance that are being faced by the corporate and accordingly deciding the course of action which we have to take in order to achieve the objectives. The financial measures, the traditional measures which we all have learned earlier, like ratio analysis, the analysis of cash flow statement, etc., are used to evaluate the performance of a firm. The selection of these measures again depends upon the corporate objectives. The financial aspects of business activities deals primarily with raising, administration, and distribution of the funds by any organization for the purpose of business operations and their successful implementation. Basically, financial policies have got three major dimensions. These are firstly the sources of funds, the usage of funds, and the management of funds or the earnings. Financial policies guide an organization so that they can run an efficient, honest, and accountable finance system. According to Cohen-Robbins, financial planning would include determining the financial resources required to meet the firm's operating program. Also, you need to forecast the extent to which these requirements will be met by the internal generation of the funds and the extent to which you will require the external funds to meet those objectives. Thirdly, to develop the best plans which are required to obtain the external funds. You need to establish and maintain a system of financial control governing the allocation and use of funds. You also need to formulate the programs and provide the most effective profit volume cost relationship and also analyze the financial results of the operations. You also need to report the facts to the top management and make recommendations for the future operation of the firm. So students, now let us try to know a bit more on the sources of funds. There are basically two sources of funds for financing the business: the sources for financing the long-term projects and the sources for financing the short-term projects. And there are different ways by which you can raise the funds for the long-term as well as short-term projects. For long-term, the typical sources of funds would be like share capital, equity capital, preference capital, borrowings, debentures, and long-term loans. You can also have some retained earnings which can be invested for short-term projects, long-term projects. For the short term, a firm can raise the loans from short-term loans, the banks, public deposits, trade credits, customer advances, leased assets, etc. Then second issue is regarding the usage of fund. Next dimension is now how to use the funds. For this purpose, an organization may deploy the funds in the following types of assets: the fixed assets as well as the short-term assets. The fixed assets would typically entail the assets like the land, the plant and machinery, factory equipment, furniture and fixture, vehicle, and other fixed assets required to achieve the organizational objectives. The short term would entail the inventories, the raw material, work in progress, finished products, etc., the trade credits, the loans and advances, the current inventories, the cash in hand with the banks, etc. So now students, we shall throw some light on the management of earnings. Basically, the management of earnings involves the decisions on how to manage the earnings and funds, whether to pay full earnings to the equity shareholders or to retain certain earnings to meet the future needs. But out of these two alternatives, it is better to follow a combination of both of them, because it is important to decide how much earnings should be distributed as dividend and also how much should be retained for the future needs of the organization. So we can say that the organizations need to have financial policies that cover the following aspects. Firstly, the operating and the operating bank accounts. Secondly, the budgeting. Thirdly, the non-budgeted expenditure, the petty cash, the receipts and the deposits, acquisition and disposal of fixed assets, payment of check requisitions, staff loans, use of private motor vehicles, car hire, long distance travel and travel allowances. It is usually the boards of the organizations that decides what policies are needed and what they should be. In order to implement a financing strategy, we need to have appropriate policies, and we can say that a financial strategy is basically a plan that spells out the actions that a company or a business will undertake in order to be profitable and successful. It includes the use of value-based performance measures and standardization of the business processes for the maintenance of financial flexibility, to support growth and keeping the capital structure more efficient. According to Cohen and Robbins, financial planning should firstly determine the financial resources which are required for meeting a firm's operating functions. It also needs to forecast the extent to which these requirements will be met by the internal generation of funds and the extent to which will be met from the external sources. It also needs to develop the best plans to obtain the required external funds. You can't take it ad hocly. It also needs to establish and maintain a system of financial control governing the allocation and use of funds. A firm also needs to formulate a strategy or a plan for most effective profit volume cost relationship. It needs to analyze the financial results of the operations and also report the facts to the top management and make recommendations for future operations of the firm. So students, now let us understand the objectives and role of the financial strategies. The primary responsibility of a financial strategy is to provide the funds needed by the organizations to support the present and the forecasted future level of operations. The following activities would typically fall under the purview of the Chief Financial Officer. Firstly, providing access to debt and equity funding in amounts and at a cost which is comparable with the corporate goals. Secondly, the management of working capital. Thirdly, monitoring the use of funds within the firm. Thirdly, establishing financial goals for capital budgeting programs. Fourthly, the risk management programs for normal operating and financial exposures covered by the insurance. Next is the risk management programs for the foreign exchange and similar diversifiable risks. It also needs to take into account the investor relationships, advising on dividend and other financial policies. A chief financial officer would also need to think about the financial resource requirements, the financial resource assessments, and also not be sleeping about the competitors. Competitor analysis is also something which needs to be done. There are different objectives of financial plans which are as follows. Firstly, adequate funds. The financial plans need to provide adequate amount of funds. Flexibility. You can't have a non-flexible straight line kind of a view towards funds. It needs to have a long-term view in terms of getting the funds and utilizing the funds. The liquidity component cannot be ignored. The optimal use of the funds, something really very important which every chief financial officer has to take care of. And of course, yes, the overall economy, which basically is the parameter for the success of a firm. So we can say that all the above are the important objectives of financial policies which provide the criteria for describing the corporate's choices regarding debt equity mix, capital structure, method of financing, investment in projects, hedging decisions with the goal of maximizing the value of a firm, and also some set of the stockholders. Financial strategies have long been standardized for assessing a firm's performance. Various organizations support the role of financing in establishing and monitoring specific and measurable financial strategy goals as a coordinated and integrated basis, thus enabling the firm to operate efficiently and effectively. Financial goals are the metrics which are established on the basis of benchmarking the goals in relation to the best in the industry, and these would typically include the free cash flow. Free cash flow is a measure of a firm's financial soundness and shows how efficiently its financial resources are being utilized to generate additional cash for future investments. It represents the net cash available after deducting the investments and the working capital and increases the firm's operating cash. The firms should also utilize the metrics when they anticipate substantial amount of capital expenditure in the near future or follow through the implemented projects. It would also include the economical value added. Economic value added is basically the bottom line contribution to the risk adjusted basis, and it helps the management in making effective and timely decisions to expand the businesses that increase a firm's economic value and to implement the corrective actions in those that are destroying this value. It is determined by deducting the operating capital cost from the net income. The firms set economic value added goals to effectively assess their business's value contributions and improve upon the resource allocation process. Benchmarking in terms of asset management is also the third parameter. Asset management calls for efficient management of the current assets such as the cash, the receivables and the inventory, and the current liabilities such as the payoff, accruals, etc. The turnover and the enhanced management of a working capital and the cash conversion cycles. Firms must utilize this practice when their operating performance falls behind the industry benchmarks or the benchmarked companies. The fourth parameter for benchmarking is basically the financial decisions and the capital structure. Here financing is limited to optimal capital structure, the debt ratio or the leverage which is the level to which a firm minimizes its cost of capital. The optimal capital structure basically determines the firm's reserve borrowing capacity, both in short term as well as long term, and the risk of potential financial distress. Firms establish the structure when their cost of capital rises above the direct competitors and there is a lack of new investments. The managers, while benchmarking, also consider the profitability ratio, which is the measure of operational efficiency of a firm. Profitability ratios also indicate the inefficient areas that require corrective actions by the management. They measure the profit relationships with the sales, the total assets, and the net worth. The firms must set the profitability goal ratio when they need to operate more effectively and pursue improvements in their value chain activities. The next parameter of benchmarking is the growth indices. Growth indices evaluate the sales and the market share growth and determine the acceptable trade-off of growth with respect to reduction in the cash flows, profit margins, and return on investment. Growth usually drains the cash and reserve borrowing funds, and sometimes aggressive asset management is required to ensure sufficient cash and limited borrowing. Firms must set growth index goals when the growth rates have lagged behind the industry norms or when they have high operating leverage. Next parameter is the risk assessment and management. Every financial decisions involve risk, and a firm must address its key uncertainties by identifying, measuring and controlling its existing risk in the corporate governance, the regulatory compliance, and the likelihood of its occurrence and their economic impact. Then a process must be implemented to mitigate the causes and effects of these risks. Firms must make assessments when they anticipate greater uncertainty in their business or when there is a need to enhance their risk culture. The next parameter is the tax optimization. Many functional areas and business units need to manage the level of tax liability undertaken in conducting the businesses, and so in order to understand the mitigating risk, also reduce the expected taxes. Moreover, new initiatives, acquisitions, product development projects must be weighed against their tax implementation and the net after-tax contribution to a firm's value. In general, we can say that the performance of a firm, wherever possible, must be measured on the basis of after-tax basis. Global companies need to adopt this measure while calculating or operating in different tax environments where they are able to take the tax advantage of the inconsistencies in the tax regulations. So now students, let us study the monitoring and evaluation of the financing strategies. Through the monitoring and evaluation, we can learn which options of financing work for us and which options of the financing do not work for us. We can learn why certain options do or don't work for us, and we can make intelligent decisions about what to do and also what not to do. Some of the ideas for monitoring and evaluating your financing strategies are: firstly, know what works and what does not work, for as we have talked of various sources of funds and their management. Also knowing how much each option costs, like going for distribution of all funds in dividend form and retaining all funds or combination of both. You also need to identify the hidden costs and the hidden benefits. For example, staff might be a hidden cost, and increased profile might be a hidden benefit. You employ a more competent person, pay higher salary. So higher salary could be a cost, whereas the performance could be a benefit. Be alert towards early warning signals. For instance, in certain cases, the costs could be too high or the returns could be too low. And also take corrective actions when we can see something is going wrong. For example, if long-term source of fund is better than short-term source, then take corrective action of switching from long-term to short-term. You also need to prepare the monitoring reports for management and the board. Also need to evaluate the efforts over years, looking at the cost to income ratio. How much did strategy cost and how much income did it yield? This can also be done on monthly basis. Look at the progress targets. Are we achieving the targets? And if not, what can be done about it? Monitoring also involves use of tables and graphs to show trends, the targets against each other, actual, monthly, annual. And these are especially useful for the people who are not really very financially literate. Monitoring also involves using the information to arrive at conclusions and make decisions. So students, with this we come to an end of this module, and now let us recapitulate what we have learned so far. So far in this module, it is clear that what is the financial policy and how it operates and monitors. We can also say that functional policies play an important role for the success in the operational performance of an organization. Financial planning basically is an estimate of the total amount of resources which are needed for implementing the action plan, and it helps to identify the potential cost savings and improve the efficiency of the plan. Also, we can analyze cost by input to understand which areas of the program involve high cost or low spending. This policy is helpful in finding various sources of funds, which source is the best for organization as per requirement. It also gives us an idea of effective utilization of funds and how to manage the funds. Students, we also have learned that finance can be a source of strength and it can help a firm in building a distinctive competitive advantage. The firms that manage their funds well, which are able to have proper balance between the stocks, the debtors, the creditors, and improve the cash flow, reduce the operating as well as borrowed expenses. Large finances helps the corporates to move ahead of the competitors with confidence. Resources can be leveraged to increase the returns from the shareholders. Firms can increase their scale of operations and derive tax concessions through mergers and acquisitions. Thus, firms that manage their funds well can build distinctive advantage over long term as well. Since financial policies and strategies of an organization are concerned with raising and utilization of funds, the basic purpose is to ensure adequate and regular supply of capital to the organization, keeping the present and future requirements of the business in mind. Capital, as we know, should be adequate, but should be judiciously employed. It should not be wasted, because wasteful use of capital is just as bad as inadequate capital. Hence, while determining the fixed and the working capital requirements, the types of securities to be issued, the sources to be exploited, the financial managers must bear in view the proper use of funds. While finalizing the future plans, all contingencies must be taken into account, and the businesses in any case should not suffer due to excess or shortage of funds. Also, the cost of raising capital should be minimum. There should be ways to find a fine balance between fixed cost bearing, securities, debtors and preference shares, and variable cost bearing, that is the securities in terms of equity shares. After procuring the funds, they must be employed efficiently and effectively. Students, we have also studied that liquidity, safety and profitability should be the guiding factors in this regard, and we also know that the finance being the lifeblood of business, the firms or businesses can survive or compete with their competitors only when they have effective financial plans and policies. Thank you.